Hello, everyone, and welcome back to the G360 podcast. Today, we have a very special guest in Mr. Brent Sullivan. We're joined by our co-host, Samuel Diarbakerly, and today we're going to be talking about all things tax alpha. So, Brent is the founder and editor at the Tax Alpha Insider. Brent, it's a pleasure to have you on the show today.
Happy to be here and to talk about tax alpha all day long.
Let's do it. So we're going to dive in today, but I think to start high level, why don't you tell us a little bit about more about you and what you do? Because I know Sam and I and some of our clients are very familiar with your work, but for those that aren't familiar, give us a little bit of a backstory and how you found your recent success, and dive deep in educating all things tax alpha.
So, my first job, actually second job out of graduate school was on PIMCO's trading floor. And that was my first exposure to a tax management practice. So we had institutional clients, insurance and banking that had really simple requests, like just make sure that you're not realizing gains on certain positions. So that was the first time where I was like, okay, this is a whole thing. This is a practice. And there were more sophisticated requests, but that was 2011. And between then and now, I worked as a software developer. I worked on another trading floor. I worked in venture capital for a little bit. But all of that, if there's a through line between all of that, it's been tax management. And everybody always asks me, like, why, why this
Hmm.
particular strain of investment management? And I see it as like an extension of a passive ethos. And I just thought, if we've already got portfolios that are low tracking error, that are trying to match a benchmark, in essence, how much more juice can we squeeze out of that? Now, I've come a long way even since then. Now I'm like highly amenable to high tracking error strategies because, maybe a benchmark is arbitrarily constructed. So now things are totally different. Now I've taken everything back from first principles and just tried to inject tax awareness just from the get-go in every investment decision.
Hmm. And when we talk about tax awareness and more specifically tax alpha, what does that really mean? Because I think the alpha term in financial markets and wealth management, investment management, it just gets thrown around left and right. And I think in a traditional sense, a lot of people understand what alpha is, but really, what is tax alpha at its core?
I think tax alpha is any action that an advisor or an investor takes to manage their tax bill. And so certain instances of that, it could be loss acceleration, like we could talk about tax loss harvesting as a
Hmm.
strategy. It could be gain deferral, where you sit on a position a little bit longer to take advantage of preferential rates. Could be making sure that dividend holding periods are adhered to so that we make sure that those dividends stay qualified. That's all just local tax alpha. If we zoom out behind or beyond just the local instance, what about ideas like asset location, where, oh,
Hmm.
which assets should go in taxable versus tax advantaged and tax exempt accounts? And if we keep on expanding beyond just those local instances, there's a lot of additional tax alpha we can discover. Could be in estate planning. That's a substantial source of it. It could be in organizing or planning around a business exit or a concentrated position. Those are
Hmm.
all instances where we can inject tax awareness into the overall investment planning paradigm.
I love it. Yeah, we as advisors, I think it's really important because I would almost argue that the tax planning and tax alpha side can sometimes be even more impactful than a really great investment return structure, because it's very rarely where we can sit across from a client and say, if we structure this entity properly, or if we plan ahead of a business exit or a liquidity exit, we can help save you to the tune of tens, if not hundreds of thousands of dollars, depending upon the client. And really, with just by either notarizing a document or putting the correct structures in place. And that's really where the tax alpha comes into play here. Um, when we think about some of the underlying strategies, we're going to get deep into the weeds, but at a high level, Brent, you do a lot of covering of the biggest strategies. So could you just put a lay of the land for some of the listeners out there of what the largest and most common strategies are, specifically on the investment side of things that investors are using?
Yeah, I think of these things and like there's four like little waves moving through the marketplace right now. The first wave is probably the disaggregating of pooled like ETFs and mutual funds into individual holdings. So
Hmm.
commonly known as direct indexing, but I think internally we would say there's a thousand shades of gray in what direct indexing means. So direct indexing takes the individual holdings of an ETF or a mutual fund and then holds some slice of those independently so that the investor can make tax optimal decisions and customization
Hmm.
within a separately managed account instead of a pooled product. So it's a portfolio management strategy. There are costs, there are trade offs, but direct indexing is one. We can expand beyond that into custom indexing. Now we're not trying to match a benchmark or an ETF anymore. Now we're trying to match a totally separate mandate. Could be high tracking error with to something like an S&P 500. In other words, it might deviate pretty considerably. But a lot of folks would say that's deliberate. That
Hmm.
tracking error is actually a good thing. So just need to be mindful of that. Now, if we keep on expanding, if we talk about direct indexing and then custom indexing, well, another form of customization would be allowing short positions into the portfolio. So now we've got longs and we've got shorts, and maybe there's some opportunity to squeeze relative value between the longs and the shorts and then also stay somewhat benchmark aware, but deviate meaningfully to capture alpha. And that's traditional pre tax risk adjusted alpha. And
Hmm.
then also, once you've passed through that pre tax risk adjusted alpha, is there an opportunity to do anything special from a tax planning perspective? And that's where I think there's just when we introduce leverage into the portfolio, there's additional surface area, and that additional surface area allows us to harvest tax losses um, more favorably than in a traditional long only portfolio. And so what that does is, and you guys could talk to me about this, it's about a planning product that allows folks to manage their gains and losses using the portfolio as a utility. Again, it's got to get that pre-tax alpha satisfied. But once you're through that and the investment makes sense, there are a lot of tax planning opportunities. Let me pause there. That's one out of four areas I see, but let me
Hmm.
pause there.
We'll dive in depth into direct indexing and specifically with extensions in long short. But why don't you follow up with the other three that you think are most commonly used right now before we dive in deeper?
So the next one is if we move over back into pooled product land and we're looking at ETFs. And so ETFs are this fascinating wrapper for the properties that they have. They essentially allow portfolio managers to redeem individual positions in kind. So if an individual would have to sell a position, realize capital gains to
Hmm.
rebalance or change strategies, an ETF has a lot more flexibility to redeem those positions without realizing gains. So the ETF wrapper is very powerful. And what I'm seeing like on the industry side is a lot of innovation using that section of the code. And so traditionally this would be in equity portfolios, but now I'm seeing these in-kind redemptions and capital gains mitigation strategies. I'm seeing them move into options. And so what that translates into is that there's an opportunity for strategies that produce some slice of income, or maybe they're fixed income like that. Those are completely managed in an active sense using options, and then all of those options are redeemed in kind, such that again these are active strategies, but there's just an opportunity to defer the capital gains on those strategies indefinitely. So I call those no distribution ETFs.
Hmm.
Isn't it ironic
And
that
there's
we've
more.
gone from
Mm.
ETFs to direct indexing, and then it all comes back to, perhaps back to an ETF and a 351 exchange?
Yeah, it's really interesting. So, so what Samuel's referring to is like if we have a portfolio of securities, like we could contribute that portfolio of securities into a newly launching ETF using in kind. That's the important thing, in kind, into a using a section of the code called 351. And what it does is you can contribute the assets and you don't have to pay tax if you satisfy a bunch of gating concerns, namely that the transferring portfolio has to be diversified and there's specific rules for how it's diversified. But the 351 as a mechanism for deferring taxation and also for helping companies bootstrap their ETFs, like this is America, like they're trying to launch their companies. the marriage of those two ideas is a really a huge trend nowadays. Stay tuned on that. I've got a whole new data platform coming out just to like visualize how all of that works.
I love it.
There's more. I think like if we start looking at alternative investments, and this is where things get really interesting because the accounting is different. Folks are now we're talking about partnership interests instead of ETFs or separately
Mhm.
managed accounts. So in the partnership interest space, I mean, one area that's really big are the so-called trader funds, and these are hedge funds that distribute traditional business losses to a household. And those business losses are subject to certain limitations, but those business losses can often offset ordinary income, and that includes wages. Again, there are a lot of boxes that investors have to check to access those products, and then there are limitations on the losses that investors can put onto their tax return, is not onto their tax return, that can claim in the current year. But the trader funds are actually quite a big deal, and they've got some unique properties around management fee deduction. That's probably one of the main properties. But then also, there's a ton going on. They can cordon off different sections of the hedge fund. One would be investor motivated, that's managing gains and losses. Another section would be trade or business, so that ordinary gains and losses pass through. It's a fascinating development in the marketplace, I would say, over the last 5 or so years. And the last section, we're getting through my 1, 2, 3, 4 here. The last section is all the innovation around concentrated position management. And so, if we're talking about public stock and someone has a big position because they've worked at a company for a long time, perhaps they're an executive and it's a function of their compensation package. Well, now there's a lot of solutions to that. I put together a diagram earlier with something like 20 different solutions to concentrated stock. And the idea is to get a person diversified or at least to de-risk them. Those are slightly different concepts, but the idea is to reduce risk in that concentrated position in a tax thoughtful way. So now we're talking about things like exchange funds, to a certain extent, a very, very limited extent, the Section 351, very, very, again, limited extent there. It's possible, but there are just like other concerns to keep in mind. We're talking about variable prepaid forwards, giving strategies, and then a whole shelf full of option strategies. And all of the option strategies are fascinating from a tax perspective. They're super complex, and it's really interesting to see the different bells and whistles that are coming out, mainly to get somebody de-risked from a concentrated position. And these strategies allow them to maintain a certain amount of exposure per their wishes, or maybe there's a gifting strategy that allows them to transform the risk entirely into an income stream. But let's just going all the way to the beginning, these 4 different areas. The one is just splitting out pooled products into individual holdings. The next is all the innovation in ETFs, and that's no distribution products, and it's also the 351 conversion. Then the third thing is innovation in alts. That includes the hedge funds that we mentioned, but there's other stuff. And then again, the fourth thing is that there's lots of innovation happening in single stock de-risking.
I think that what's kind of most exciting for us in our firm is that we're a planning based firm. Like we'll tell clients like, hey, you're not getting an investment proposal until we rubber stamp your financial plan. Like what rate of return do you need? What's your longevity risk? For us, most of our clients, their retirement plans look like how much money can I give away and still meet my cash flow needs? One of the things that I'd love to get your opinion on is we talk about the complexity curve a lot, and if we look at this as a frontier, like where does the complexity and the alpha meet? And meaning, for us, I think a lot of these strategies work together best in tandem, not in a vacuum. For example, maybe hedging a strategy with collar and then running, a long short strategy, parallel to that, also being thoughtful about, hey, look, you might want to not take 60% of your liquid net worth and put it into a long storage strategy because there's underlying risks that may be out of our control, like custodial or management, et cetera. What do you see that's going on in the industry right now, in broad strokes? Are these strategies over democratized? Are they not democratized enough? Many of them are not available at the large banks, so you have to go through an independent firm like us. I'd love to just kind of get your general thoughts, and we can kind of bring the level down to talk more about like individual clients and how these strategies are applicable.
Yeah, I think about a buddy of mine coined the phrase the explainability ratio. And so he's talking about how hard it is to, fine, we can play with the Lego pieces and we can put the different strategies together to try to create a certain outcome, depending again on the client's objectives, again, gifting, capital gains minimization, business exit, whatever it is. Like we can do all of those things, put all those different pieces together, but like do they get it? Are they comfortable with all the risk there? Because if as soon as we start chaining different activities together, there's the isolated risk from each individual strategy, and then you start compounding the risk when you compound the strategies. And like it can be a very effective, and there are well-worn paths to combining some of these strategies out there, and the incremental risk from combining strategies, like long short plus a collar, something like that. I mean, that's like the patterns are sort of well known in certain cases. The risk has been brought down. The unknown unknowns box in that quadrant is much smaller than in other sort of like frontier type categories. So I always think about the first thing is like the explainability ratio. Like it's such a helpful little framework to be like, does your client have tolerance for it? Like you might be able to do all this work, but do they care? Is it going to achieve the steps that they or the result that they want thoughtfully? And are they willing to just like sit back and let the professionals do their work? Some people are not comfortable with that. They want extremely simple solutions. And so you can think about explainability as almost being a constraint on all of the solutions that are available to achieve a certain outcome. And so that's always the first thing. Like, can we explain the crazy stuff that we're about to affect for clients? And then if you can, if they're comfortable with that, then you can be creative. You can start saying, oh, I've got the widest possible set of solutions available. Now, in doing so, like what are the risks that I am introducing into the household? Of course, you've done diligence on all these things beforehand, but is there any unique risk out of combining these strategies? And is there anything that you should be telling the client? Is there anything that you should be warning them of? What is the strata of risk that you're taking? Is it pure market risk? Is there tax risk? Right? Is there a chance that they're just not going to sleep as well at night because they're doing something really out on the edge? Now, hopefully, we're not even like talking about anything like that today. But most of the products that we're talking about have like pretty long history, more or less, and have are sort of above board. They don't require crazy opinions or anything like that. But that's how I think about the explainability of it. But then there's risk. We can go a layer deeper on risk if that would be interesting. But what would be most helpful?
Yeah, I think one of the things that I think about, right, is when I talk to ultra high net worth families across the country. I'll travel, I'll sit in their living room. And then as soon as I talk about the tax benefits, nothing matters, right? It's just, oh, I want to do that. And I think what's helpful for us is to kind of understand what are the most common ways that you see end clients applying these strategies? What are the stories of that don't work, right? Like, you always have that friend who's like, "Oh yeah, I just bought a put on an ISO and then didn't know it restarted the holding period." I think there's that significant level of complexity. And I think right now, and I'd love to get your take, obviously, you're the authority on this, is the hottest strategy right now is long short. I think that is the most common, most demanded. And I always had my kind of aha moment when we've gotten a couple inbound emails from people just saying, "Hey, I saw you on TV or I saw your podcast. Can I sign up for a long short stretch?" I'm like, "Whoa, whoa, whoa, hang on. Like, let's learn about the entire need." We're like, "No, that doesn't offset income. There's no need for this." But would love to just kind of see what you're seeing. I know you've done a lot of work and generated. You're a meme king, by the way. The work you do on LinkedIn is much worth a follow. And I know you've done a lot of work on scattergrams talking about risk, and would love your opinion on what are you seeing as like the most prevalent risks in long short, and maybe risk isn't the appropriate word, but it may be more considerations of, hey, I need to know that this is a potential to happen, because what you could do is potentially maybe convert a long term gain into a short term gain, or have a lot of complexity unwinding.
Yeah, I think that the first question that you or your initial hesitation was exactly right. It's like, does this even make sense? Like you're getting this inbound email, like people are excited because they're hearing, fancy words. They're like, oh wow, there's going to be so much tax alpha here. And it's like, actually that's not the thing to lead with. The thing to lead with is to start with, does this investment make sense? Like, does it generate pre-tax alpha? Does it even have the potential to generate pre-tax alpha? And once you move past that concern, okay, now we're in sort of a different mind space, but it must start with the investment rationale. And so it's funny that, I of course, I write about taxation of investment products like every single day. And I have to pull myself back and be like, wait, like I've gone too far. Like this needs to have a whole pre-tax rationale before we even start thinking about the tax stuff afterwards. And I think that's just a helpful calibration on like, does this even make sense for this client? Because what'll happen is if you put on a tax motivated trade, okay, set aside all the like IRS risk and things like that. If this thing starts to underperform, then they're mad. And you're like, wait a second, like you noticed all the tax benefits, like that's what you were excited about, and we're going to give those to you, but you might underperform. They're like, what is this? I don't understand. What's all this risk? And it's like, yeah, that's actually what we're talking about. Like as fiduciaries, like the bar is to get everybody comfortable with the pre-tax risk, and that's proportional gain and loss. That's a technical concept, but the idea is that they need to feel comfortable with the investment, and then we can start using it as a planning product. And I think that's always the first thing, because I get those inbound emails too. Folks are like, "Hey, can you make a reference to an advisor?" It's like, "Yeah, sure, but by the way, what you've told me doesn't really need this strategy." And so that's the first thing. Do we even need this long short strategy? We should probably talk about the mechanics of it. Like, I feel like even when I talk with really sophisticated folks, they're sort of just unaware of like how this thing actually works under the hood. Would it be helpful to sort of take it from the ground up?
Yeah, I think so.
All right, so let's start with a like a common situation. Somebody has got, let's say, $10 million in a tech company stock. And at that point, they're trying to figure out like, hey, should I keep holding this position, or can I put this stock to use in some other way to generate additional returns in my portfolio? One solution or one path is to take that concentrated position and to put it into a long short strategy. So that's a portfolio margin account that starts with Reg T, first of all. That's just a limit on how much margin you can add to the portfolio, but then you can upgrade the amount of margin to a risk-based portfolio called portfolio margin. Essentially allows more leverage. But the first step is getting that asset into a brokerage account with margin or portfolio margin capabilities. The next thing that happens is a third-party manager is going to introduce proper margin into the portfolio. That's a full borrow. And then they're also going to short a bunch of positions, let's say correspondingly. And these positions are different by construction. The portfolio manager's objective is to squeeze relative value between those additional margin positions and the short positions. They're really trying to achieve alpha between those two positions. This is an overlay implementation. Remember, we contributed Google stock. We've added margin on top. We've added shorts on the bottom. So you can think about that as just a column stack of the total exposure that you have. All that margin, the concentrated position still, you haven't touched it, you haven't done anything with it. And then the shorts. And the shorts are interesting because they have their own unique risk profile, but they can often act as a sort of risk hedge for the longs. So it's important to note that there's some risk management capabilities there. Once you have that portfolio established, the market is going to bounce around. And since you've injected so much leverage into a portfolio and the leverage can be flexed, the lowest I've seen is 110-10. So that'd be 10% margin, 10% shorts. And the biggest I've seen, maybe I won't say that, but let's say a big one that I've seen is 300-200. So that'd be 200% margin, 200% shorts. So again, you contribute $1, you've added $2 of margin, $2 of shorts. So your gross exposure there is the 2 plus 1 plus 2. And I think folks need to get comfortable with that. That is a tremendous amount of exposure in all different shapes and sizes. So that's the overall like structure of it. Now, what happens when the market starts bouncing around? So first that happens is that the portfolio has potential to underperform on a pre-tax basis. It could just fall behind basic index exposure. Folks are unprepared for this, and note that the magnitude of that underperformance is proportional to the amount of leverage that you've injected into this thing. So you could underperform. That's a drag. People don't like it. It's like literally a drag. But there are substantial planning opportunities. One, you've got that pre-tax alpha, hopefully that's coming through occasionally on a long-term basis. And then you've got these planning opportunities. You've got so much surface area out there. Again, you contributed 1, but you've got 2 plus 1 plus 2 in tax loss harvesting capability. And so now you can harvest losses on the longs. You can harvest losses on the shorts as the market continues to appreciate. And so a lot of folks are very attracted to this as a planning product. They say, like, I'm going to get all of these losses. This is great. I'm going to defer my capital gains tax bill indefinitely. And it's like, yes, yes. I mean, some of those things are definitely possible. So the first question I always wonder is, do you actually have enough gains that require this? Do you actually need this? And you could be using it to get out of that big concentrated position that you used to seed that portfolio in a tax neutral way. So you've injected leverage, you're going to harvest a bunch of losses, you're going to start winding down that big tech company stock in a tax neutral way. You could definitely do that. Or you could just let the position ride, depending on your perspective on the tech stock or just how you see things going. But those are the mechanics. I think that's like sort of a beginner-ish treatment. There's so much more to cover, but let me stop there.
I think that was one of the best explanations in 2 minutes that I've heard in the last 3 years.
It's definitely great because, Brent, what you're explaining is that all of these strategies increase complexity in clients' lives, right? And so, step one, which we've laid out, is you need to have a proper use case, right? These strategies are not there just like a broad market, low cost index ETF to get you passive beta. That's what they're not doing, right? They are getting you exposure to a type of strategy that either can generate pre-tax alpha, that can potentially use extensions to hedge out some risk that has a positive correlation or a similar beta to the underlying concentrated position that you have. And the benefit to the quote unquote investor, or I would say the tertiary thing, is that you're going to generate capital losses in this strategy. Where I think this goes wrong, and where I think I'm seeing a lot of overselling in our space, is advisors and or people with broad reaching capabilities are going on the networks and leading with the tax benefit, right? And at the end of the day, that's the worst thing you could do, because if you lead with the tax benefit, you're not doing a service to your client by exposing all the risks that come with this, right? We have a saying at Generation Capital Advisors that simplification is the ultimate form of sophistication, right? And all of these strategies add complexities, which kind of goes against it. And so I think step one just has to be, you need to have a real use case, right? Either you're a business owner that's having a liquidity event, you're an early employee at a public company that either recently IPO'd or has become a larger position in your portfolio than you're comfortable with, or if you're having some kind of exit, right? Those are the biggest areas. Now, I think when it comes to the trader fund or the hedge funds, right, those are a little bit more nuanced. Those could be, high earners or business owners, for example. And I would argue that the use cases for those comes down even more, just because the complexity there, you're adding tax complexity, your K1 reporting there. The gross exposure is another really big thing in those funds, because depending upon the fund, you can see sometimes 7, 8, 9% or 9 times gross exposure for every dollar that you put in. And I think it's just important as fiduciaries that we disclose those things, and you ask, what's the use case first? How do we pair that with a strategy that's going to give you a really good solution, but not expose you to risks that you're not comfortable with, right? So I think that's the biggest thing that I'm taking away as we talk about this, is there's so much complexity in these strategies, yet there can be exceptional outcomes. But it's just important to do your homework, to think about things and to structure them properly, and to set the right groundwork and expectations with clients before just leading with the tax benefits. And, at the end of the day, that really is a disservice to them.
I think also,
go ahead.
One thing to add on that, Rex, is, what I'd like to do is empower investors. If you're watching this, obviously we'd love for you to work with us, but if you're working with another advisor, I think almost, an idea that we should make is just a quick cheat sheet, right? Like, hey, do you have other clients in this strategy? How much money are you managing in these types of strategies? I mean, especially with the trader funds where you can, have at-risk basis and excess business loss. And, I've seen some nightmare things where, you put this in an S corp and, blows the whole thing up. And now, there's so much democratized access where a lot of the advisor community, which obviously, there's so many talented advisors out there, but, you really need to have a great tax platform and an institutional research platform to make sure that you're implementing these in a thoughtful way. And my concern for end clients is, especially with the trader funds, it's like, oh, is this going to give me tax savings? Sure, just throw it in my business account. Doesn't matter.
Yeah, I mean, I think I totally agree. So I think the progression that I see is that when folks discover tax management is appealing to clients, when advisors discover this, they're like, oh wow, I need to reorient my entire practice around tax management. And it's like, yeah, but then they take it too far. I can always see who's out there. I can see them just being too aggressive with the tax messaging. And it's like, look, you're attracting like a certain type of person who is really attracted to the tax benefits as a primary concern. And that really is like the tax tail wagging the dog, that old adage that ends up being so useful. And we just need to say it over and over again. All of the decisions must have investment rationale. They must
Mhm.
fit into an investment paradigm. And then, as a very, very secondary concern, you've got tax attributes that can be used for planning. But anybody who goes too hard as tax as like a primary concern, they're sort of missing the big picture. And that's when folks get really mad. And I mean that they're just like, oh, wait, all these tax benefits. I thought everything was gravy. No, it's not. Like all of this stuff is proportional. There's very little free lunch in this world. Folks will say, oh, tax alpha is free lunch. It is not. There are trade offs between risk and tax, and there are other complexity. All of these things cost. All of these things ramp up when you embed additional tax aware strategies into your portfolio. And you use the word democratization. That's really where I get uncomfortable with this stuff because it requires you putting on your small reading glasses and doing hard work and figuring out what the actual risk is in the portfolio. And if all that the client is hearing is tax, 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 it really is quite cringe. I mean, it's just like, look, you are missing the big picture here. And the big picture is that this needs to be part of a thoughtful construction of overall household wealth with planning, cash flow management, intergenerational concerns, federal and state tax management. All of this stuff needs to come together into a thoughtful plan. And if you're just like tax, 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 it's just too much. It's too strong. You're focusing on the wrong thing.
I think a great anecdotal story is I was meeting with a client, their attorney, and a CPA, and we were talking about using long short. And one of the funny things that I thought, just based on your language that you're using in this podcast, Brent, is tax neutral, tax deferred. And the client kept on saying tax free. And the attorney made a joke and he goes, well, if you want it to be tax free, you have to make the ultimate commitment and you have to take this thing in the ground with you. So, I think that that's another piece of the puzzle, right? Like, there's also a complexity in the shorts, but none of this stuff is that free lunch. It's tax deferment, and that is encompassed in the overall plan. Hey, maybe we're just going to defer this into when you're into a lower tax bracket. There's all sorts of other complexities when you talk about the planning. Like, hey, are you doing this in a irrevocable trust? Well, hey, now you're never going to get a step up. Maybe we want to do an asset swap. There's the complexity can get so far, but it's not just around that tax managed piece. It's around implementing it in the broader picture, which I think, we're all in alignment with. But I would encourage end investors to think not only in a vacuum, but think about this holistically. How does this work with your entire plan? And a great question is to ask your advisor is, okay, well, after year one, what are we doing? Are we flexing it down? Are we flexing out? Are we dying with this? What's the goal? How do I monetize this?
Yeah, exactly. All of this needs to be woven together into a comprehensive view of the household balance sheet and how that balance sheet evolves over time, what needs to be in estate versus estate excluded, all of that planning stuff. I mean, that's the kind of stuff that gets me excited. I'm like, wow, check out all these cool products, and these cool products can enable certain goals, but really the end goal is what matters. That's, considerable, stewardship of these assets over generations possibly. And I think that's really hard to get into a social media post. Like, look at all this boring planning that we're doing, matching all these gains and losses, and making sure that you like, you're gifting in a thoughtful way. And look at all these AGI limits and EBL and all this different stuff. And like all of that fails on social media. It's too boring. Good. Like it needs to be boring. Like the work that you're doing is work that is worth outsourcing to a competent fiduciary because it's tedious. It is not spicy and sexy, except for when I put a meme out there. but 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 for the most part, this work is boring, and I like it for its boringness. It's like, look, you really want like a family CFO just to like go and handle all this stuff for you, and like really going hard in one dimension of it, which would be the tax dimension, is just it's just lopsided. And so back to democratization. Whenever I see like a tech platform come out and they're like, "Oh, look, we've got long short, anybody can access it now." It just makes me just very uncomfortable because I'm like, do you need all this leverage? Do you need the additional transaction costs and the portfolio management fees? Do you have gains that you need offsetting? Are you in Washington State where the losses that you're harvesting really just aren't that useful? I don't know if you guys have clients in Washington State, but we're a unique planning
Yep.
consideration up here. So anybody, so I had an individual, and I deny I'm not registered, so I have to be clear about that. So I do not provide individual advice. I do not even acknowledge the individual circumstances. I send that business to somebody else, to a fiduciary can handle it. But I had an individual reach out to me in Washington State. He says, "Hey, I've got this business exit, making $1 million a year. I want all these strategies. Can you point me to someone?" It's like, yeah, I can, but I mean, low cost, of course, is always the thing. Like, how can I get this for next to nothing? And it's like, yeah. So the trouble is that like a competent fiduciary needs to like spend their professional waking hours grilling this strategy. And like, by the way, you want them to do that. And then you want them to consider this strategy in the context of your entire household wealth. And like for you to show up and ask for a point solution that's dirt cheap, there are solutions out there that will satisfy that need, but I'm telling you that it's really haphazard and one dimensional. And like, what is the point of that? Like, this is wealth. Like, let's take it seriously. We're talking about real money here, and it just seems gimmicky to me to turn that over to maybe just a little tech platform or something. There's
It,
just so much left on the table.
it's really interesting because I think one of the most important factors or ideas that we have to drill home is that not only do we help clients make really smart financial decisions, but I would argue what's more important is sometimes we tell clients not to make stupid decisions or financially immature decisions, right? Or to lead your investment portfolio because of a tax consequence, right? So I think, we run into that a lot. It's just really important to make sure that you're correct. If you're thinking about, an exit, for example, you have to make sure that these strategies and solutions are the right thing for you, right? And more importantly, the fiduciary should be able to tell you what to do and what not to do based on what your overall goal is and what your outcome is. Sam, I wanted to, you said something about implementation, right? And one thing we haven't touched on yet, which is the talk of the town right now, is around custodial risk. And that goes both ways for advisors that are running practices, but also for clients, right? Brent, why don't you give us an overview of what's gone on recently and, what your take is? Obviously, we're not going to hold you to it, but there's a lot of theories out there. But talk about what happened with Fidelity and what you think about the scenario.
So, sometime in December, Fidelity announced that they were going to halt onboarding of new tax aware long short strategies. And they said that this halt was going to be temporary. I think it was going to end in
Hmm.
January, February. I actually can't remember. And so, at first glance, it was like, oh, yeah, whatever, short staffed over the holiday. They need a chance to catch up on stuff. Who cares? Who's opening up portfolios during this time of year anyway? Plenty of people, by the way,
Yeah.
because these portfolios take a minute to set up, portfolio margin, et cetera. So anyway, the advisor community was grumpy about this. End clients were also grumpy about this pause. And so in some instances, individuals had onboarded or gotten acquainted with the Fidelity referral program and had asked for a referral to an advisor because they were interested in a long short implementation. And then the advisor was unable to actually set up that account for them. And so now you have a grumpy advisor who can't manage their practice around this product. And then you have a grumpy end client who's like, "What's going on here? Like, we're trying to, hopefully solve this need that my family has." So then time goes by. Turns out that this pause is getting extended a little bit further, and then more recently it was extended indefinitely. And so, as far as I can tell, based on my reporting, is that the pause will remain in place. And previously I was aware of exceptions. Advisors would tell me, "Oh, we were able to get a client onboarded," and I believe that has stopped. Also, again, if I'm wrong about that, but I believe my reporting is current. And so, with that pause in place, what I'm seeing a couple interesting developments. One is that it appears that other custodians are absorbing the volume
Oh, yeah.
that Fidelity
Notably, Charles
totally right.
Schwab at FutureProof recently
Yep.
said we want all the business.
Of course. Yeah. And why wouldn't they? And I do have let's say that I've got four different reasons that Fidelity might have pumped the brakes. I'm gonna like not say them like on a recording here, and the reason is I don't have firsthand reporting on it, and but I do have a lot of speculation. But the speculation I just think isn't that valuable. The reality of the matter is that a lot of advisory practices that were single custodian, just Fidelity now, have onboarded a second custodian, and that in some cases is disruptive, at least to the business practice. And now clients, so you have to think about some of the clients that were in Fidelity referral program. It's like, what's going on here? Like what exactly happens with them? I don't have the answer to that. But the other thing that's happening that's interesting is that other custodians have really started to ramp up their development of margin and shorting capabilities. So the other custodians that are coming online, Pershing, I know, is making a big push into this space, and then
Mm,
Goldman Sachs has a custody platform also. And we can't forget, Interactive Brokers is out there. They're managing strategies right now, and it's funny. I was talking with a long short manager maybe a month ago or so that uses Interactive Brokers, and I thought, like, what is this? Like, that's kind of, it's like it's a fine platform, but it sort of doesn't have the same attributes as like a Fidelity or a Schwab. And it ends up being this great redundancy mechanism. I was really surprised by this. I was like, oh yeah, of course you have redundancy now. You don't even have to like really worry about this because you've got multiple platforms who can independently satisfy the long short mandate. And again, that's all the margin. They are a lender to the individual clients, and the lender is lending cash for margin, and they're also lending individual positions for the shorts. So just having access to a full other balance sheet, Interactive Brokers balance sheet now, is just super interesting. So anyway, there's a lot more volume coming online to satisfy the demand for this strategy in particular. But let me just zoom out and say that, like, oh, this is interesting. Like, we have custodial risk that maybe, again, from a practice standpoint, but also from a client standpoint, that is worth highlighting.
mhm.
So they can shut down the business. They could change the haircut that they apply to individual positions that are marginable. These are all just things that I think a fiduciary has their sort of pulse on, or is sort of aware of what's happening at the platforms. Versus like an end client maybe would do this as a hobby kind of, but a fiduciary has to know these things. And so it's just interesting to have those two side to side. But we do
Yeah,
have custodial risk. It is a counterparty of a different sort. It's not credit, it's a different kind of thing.
It's always funny when, these things happen and then you have to re-highlight, hey, remember when we implemented this strategy, you had to sign a 70-page DocuSign for portfolio margin? Well, somewhere on page 64, section D, subline 2, so they can shut this thing off at any time, right? So I think that that's really important to know, because what you could do is, in these strategies, and you have to really highlight this to your clients, is you could morph a long-term gain into a short-term gain, or take something and make it more tax inefficient. There's all sorts of leverage risks. And maybe the most important thing we haven't talked about, and maybe this is for another post, is that these strategies have been live while the market's gone straight up, and we've had some volatility, but nowhere near like maybe a December of 18 or a 2008. That is another thing to consider: is, have these been live in client accounts, tax loss harvesting in a 30% market correction? That changes everything. Tracking error, long shorts, shorts covering the longs, uh, far more complexity than we have for the last couple of minutes. But I think it's an important point.
I have a funny anecdote, or not funny. It's just a dire anecdote. It's interesting. So I was talking with a long short manager who manages long short portfolios in Europe. And so during the COVID crisis, let's say, I don't know, we all remember this, unfortunately, but we all remember it. It was 2020, pretty much March, April. Europe had actually halted short selling in certain countries. Well, now that's crazy. I mean, so this guy is managing a long short international portfolio, and he's got certain countries that will not allow short selling. So you could close a short because you're repurchasing to close that individual position, but you could not reestablish a short in that country. That's crazy. So what do? He had to kind of like squish all of the individual exposure into other countries to try to keep the factor exposure the same as it was pre and post. Now, you can't get that right. But the reason I bring this up is because all of this risk, these are just things that you introduce into the portfolio that clients are just like not even thinking about any of this. And so all the planning considerations, the incremental risks, the really oddball stuff that I like researching black swan type stuff. I think it's super interesting, just, intellectually, but it's all there. You've introduced all of this complexity into the portfolio. What happens when things change? Those are just things to be aware of and diligence the best you can.
I do love also researching the black swan stuff. Unfortunately, I do it late at night, which makes it hard to sleep well.
What I'm gathering here, Brent, is that it just goes back to the main theme of this podcast, which is yes, there are strategies that are out here that can greatly benefit end clients and end users, whatever they're going through in their financial journey. But what's most important is that you understand there's a use case for everything, and there are risks that are associated with each of these underlying strategies. There are endless amounts of success stories that we can share, but where you're doing yourself a disservice is if you lead with the tax savings as opposed to the pre-tax alpha, or you lead with some of the tertiary benefits that kind of glance over what these risks are. Um, so, Brent, we talked a lot in depth about a lot of these strategies, but when we zoom out a little bit and we go back to tax alpha, we're talking all about what's going on and what's on the cutting edge right now, but where do you see tax aware investing going in the future? And what do you think is going to change? Is it going to be a race to zero on fees? Do you think it's going to continue to democratize and break down the barriers of entry? Do you think it's going to go the opposite way? What do you think is going to change over the next 1, 3, and 5 years in regard to tax aware investing?
I think the advisor layer, so where you guys operate, is just going to get better at servicing clients. And so I think that the complexity of managing a household wealth is going to get easier. And so maybe the tooling will improve to a certain extent. I'm not even going to talk about AI nonsense. Like, I think what's actually going to happen is that you all will just have better data and analytics and tooling for your specific cases that enables you to serve clients better. Yes, there will always be some chunk of the market that wants to self-serve, DIY. There will be some tech-enabled platform that goes down market. The funny thing is that, like, in wealth, that pattern doesn't really work. I've never seen democratized wealth products. Let's set aside the ETF. Let's say that's a democratized product that just has obviously killed it. But, like, in terms of like really sophisticated, detailed planning at the family level, high net worth, ultra high net worth, in general, it's really amenable to spreadsheets and deep thinking. And like that kind of stuff like doesn't really happen in tech mode, because tech mode is interested in productization so that they can scale their product. Okay, well, now high net worth, ultra high net worth is the opposite of scale. It's detailed, it's really minute, and it's matching things in spreadsheets. It's
Mhm.
like deciding if you want to swap an asset from an irrevocable trust. I mean, it's like, and then by the way, it's also filling out all the paperwork to do those things. It's deciding on a fiduciary, it's deciding on a trustee, it's deciding on multiple trustees. It's making all of these really complex decisions that have nothing to do with tech platforms or buttons and forms on websites. Like, and I say this as someone who wrote code professionally for 6 years and then left the industry, and I went and worked at Zillow Group. I was a DevOps engineer. I'm like as nerdy as you can get in this category. I love it when things scale. But what I'm telling you now is that high net worth, ultra high net worth does not scale. That's fine. That's someone else's problem. Like, it is not the family's problem that you can scale your practice. Like, ultimately, your clients are well served by you just like really, again, getting out the tiny reading glasses, turning on the light at the end of the night, and doing hard work for them. And I think that might get a little bit easier. But democratization is one of the biggest misnomers in this space that I've, or not misnomer, it's a misleading red herring kind of thing. It's just so off the mark from what actually happens in high net worth, ultra high net worth. And I think that if anything, AI is going to make it easier for you to manage your practice, but not to blow it all up with some tech platform that renders wealth advisory unnecessary. Like, no, you're going to be able to create tooling that makes your job easier and to deliver better solutions for your clients. But I don't think you'll be disrupted by this. I'll say that on the record. Put that out there. Brent says ultra high net worth is not going to be disrupted by AI. You know,
I think you're right. I think it'll make us work faster, smarter, and better. I think that's a great way to kind of wrap up the podcast here, Brent. And first of all, really, really appreciate you taking the time and sharing your expertise. As we wrap this up, we always like to give the floor to you. You're doing some pretty cool stuff. Obviously, you've done a lot of thoughtful research. You've really become a staple in the tax alpha community. What's going on with Tax Alpha Insider? How do people find you? What's coming up? What's exciting? What's going on in your world? The floor is yours to end it out, Brent.
I try to make my content accessible. If you go on Reddit and you search for me, though, you're going to find that people are like, yeah, this is like all inside baseball. And that's right. So like my writing over at Tax Alpha Insider is very nerdy. It's for folks who focus on this stuff. And so you can find me. I publish 3 to 4 times a week. And I try to keep it light, but also I'm gonna try to inject tax awareness into every single investment management decision. And you'll note that I say the word inject. It is not the leading thing. I know Tax Help Insider, that's the name, but you know that like the investment decision loses credibility when you lead with tax. So I'm always going to start with the investment decision, but then always just make sure that tax is woven into that investment framework. So that's what I do over at Tax Alpha Insider. And then at late May, I've got my conference. It's the inaugural event called Basis Northwest, and it's just a 2 days of taxable wealth innovation, mostly for the advisory community. I do have some single family offices coming though, and that's all about the latest and greatest in tax management. And so that's May 28th and 29th in Seattle. If you're free on those days, you want to go to the Mariners game with us on Friday night, let me know. It should be a good time.
Awesome. Well, I'm sure it's going to be a riveting conference and a lot of intellectual capital in one room, focusing on how do we best advise and implement for the high net worth and ultra high net worth community. But with that being said, Brent, we really appreciate you being on today's podcast and helping us challenge the way we think and continuing us to make us better advisors. So for everyone listening, if you have any questions about today's episode, feel free to reach out to us. I hope everyone has a great day.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.